And joining us now to talk about this is Angelo Taningco, Research Head and Chief Economist of Security Bank. We will get his insights on the latest global oil price movements and what this means for the Philippine economy and the stock market. Good morning, Angelo.
Good morning, Dan. Thank you for having me.
All right, Angelo. So we've seen the prices, the oil prices hitting $80 per barrel already, but it has come down a little bit. It's now hovering around 70, between 70 and 80. What is the risk here, and what are the immediate actions that you believe should be taken to protect the economy from this?
Well, indeed, the global oil prices continued to be tilted to the upside. I think last night we saw again another round of military retaliation in the Middle East between U.S. And its ally, as well as Iran. So oil prices have gone up, I think, for 4 straight days already. And if I'm not mistaken, the Brent as well as Dubai have already topped $80 per barrel. So clearly, there is a need for the countries around the world, especially importing countries like the Philippines, to cushion these price effects coming from oil. And we think that the government is on track to provide the safety nets needed in order to temper the adverse impacts of these oil price hikes.
You are clear on that uptrend that there's still upside risk and it will probably stay above $80 per barrel.
Yes.
Okay, which is already the threshold, no, that was mentioned by PBBM himself on whether to review the excise tax issue. Give us an idea on how the economy will be impacted in the very short term just by this. We already saw fuel hikes in the pump prices, but there are also talks that we have 60-day reserves. The prices will be at a staggered level. The excise taxes might also be cut. Is this going to be enough for the karaniwang tao to be able to do their normal work?
Clearly, the Middle East conflict is a headwind to Philippine economic growth. This is because, one, the surge in oil prices will raise oil import costs, and therefore that will be negative on our trade performance because this will tend to widen the merchandise trade deficit. Furthermore, we have seen already disruptions on international shipping routes as well as the travel in the Gulf states. And therefore, that will hurt our exports of goods as well as services. And that will constrict export performance, further widening the trade deficit. And the trade deficit widening is negative to the Philippine GDP growth. Likewise, domestic demand will likely be adversely impacted because inflation is on the rise. Of course, later this week, we'll have the February inflation print, which does not yet take into account the oil shock. But we are already seeing a potential upside surprise on the February inflation because we peg it at 2.6% versus the
Okay.
consensus of 2.4%. But for this month of March, because oil prices have already breached $80 per barrel globally, then we will not be surprised if CPI inflation will top 3% for this month alone and could track higher in upcoming months for as long as the Middle East conflict prolongs. And as a consequence, this could dampen consumer spend, which accounts for 70% of our GDP, because of the higher inflation that we will see over the near term as a result of the crisis in the Middle East.
We'll get back to you on the inflation story, but just to get your reaction here on the Department of Energy saying that we have different sources to import our oil, particularly crude oil, so we're not completely dependent on the Middle East. How confident are you about that statement?
Well, indeed, there is an inventory of about 2 months' worth for our oil. However, in terms of the sentiment that is being afflicted by this crisis, we could also have a dampening of both consumer and business sentiment as early as this month of March and in upcoming weeks and months. And that also could drag our economic growth. So indirectly, despite having sufficient energy buffer for now, there are other effects that could manifest from the Middle East crisis that tend then to be negative. So aside from oil, for example, you could also see a hike in shipping costs. In fact, the Philippine Ports Authority already mentioned that there could be an upswing in freight costs as a consequence of the closure of the Strait of Hormuz, which accounts for 20% of the world's energy supply. So for as
Right.
long as you have those kinds of shutdowns on our shipping routes and also the travel is being dampened as well, then we believe that these overall disruptions on international trade flows will raise supply costs because the raw material costs will also be elevated. Plus the fact that you have the peso already weakening as well, the dollar peso settling at 58.4 already
Yeah.
yesterday, and that will likewise be a burden for importers moving forward.
Should the Philippines suspend excise taxes? This is not the first time we've seen this situation. We saw it also in the pandemic, and it's very, very difficult because then you lose a bunch of revenues for the government as well, which we've already seen in last year's growth print. We weren't able to spend. The government wasn't really spending, and this hampered growth. And we do have, a debt to GDP ratio that's increasing that we need to be financing here. So what's the next step that should be taken? You've also got Senator Gatchalian saying let's use other funds muna before we start suspending taxes.
Well, I think that as mentioned, we have already experienced this before, having an emergency suspension for the excise tax on petroleum. But this ought to be temporary because there are foregone tax revenues from it, as mentioned by the senator. There could be, foregone tax revenues of about 30 billion pesos per month, or more than 300 billion pesos per year if you have a prolonged suspension of the excise tax. So to me, I think it ought to be temporary for as long as we go through this challenge from the oil price shock. But then again, we think that the oil price shock would, of course, wane. But that is conditional on the fact that you have a stop in the conflict in the second quarter, potentially, because President Trump mentioned 4 to 5 weeks timeline for his military offensive against Iran. However, as you pointed out, the debt to GDP is already relatively high. I think the highest in 20 years for now. Yesterday, we saw the budget deficit print for 2025. It's relatively narrowed compared to 2024 at 5.6% of GDP. And that's because the revenue growth weakened. I think it was flat. So that again shows that there is likewise a need for us to bolster our tax revenue effort. And that will be more challenging, especially if we have a temporary suspension of the excise tax on petroleum.
Angelo, let's go back to the inflation story here. We've had quite tempered inflation until this issue happened, right? And in fact, the BSP has been in an easing cycle. There was a lot of bets that there would be one final rate cut on April at least. What is the scenario that you're looking at for the rest of the year, given these developments? And how do you think the BSP is going to be managing monetary policy?
Before this war occurred last weekend, we have already penciled in a higher inflation print this year at 3.1%. But this assumes that the global oil prices stayed at around $70 per barrel. Now
Okay.
we've seen at least a $10 jump for now. If that persists, then we will likely revise upward our inflation forecast. And because as we have seen back in 2022 when the Russia-Ukraine war erupted, inflation topped the target range. I think it was close to 6% at that time. So clearly, it's inflationary, the oil price shock, as well as the conflict in the Middle East. So at the same time, our house view for monetary policy is that after February 19th cut, we do not expect any more cuts for the rest of the year. And I think this is augmented by the fact that inflation expectation is now on the rise because of this oil price hikes that we are going to see locally as well, because of course we are heavily dependent on oil imports.
Angelo, you mentioned something quite jarring there, 6% inflation, and that just reminded our viewers here during the Russia-Ukraine, invasion of Ukraine by Russia. Give us an idea, how is this comparable? Are we going to be seeing something at these levels?
Well, in terms of the spike in geopolitical risk, in fact, the spike there is much sharper now versus in Russia-Ukraine war back in 2022. And this is evident in an index called the Geopolitical Risk Index that we closely track as well. So yes, it's comparable. And the question now is whether this will be short-lived or whether we can see months of conflict and heightened geopolitical risk. So for us, we believe that for as long as the geopolitical risk remains elevated, then global oil prices will remain elevated, especially if that risk is emanating from oil-rich states like those in the Gulf area. And hence, inflation risk is much higher now, and the chances that it might even go closer towards the upper bound of the target range or even breach it has increased as well in light of that the tension arising from the oil-rich region.
What is your outlook on the peso for the short term?
Well, for the short term, we think that the dollar peso will be between 58 and 59. Although there is, of course, some expectation that it might eclipse 59 if we see oil prices, say, go up further, closer towards $100 per barrel. But we have enough external buffers in terms of foreign reserves. So we believe that the foreign reserve will be enough in order to temper any sharp peso depreciation, which is unwarranted because that also constitutes excessive volatility in the exchange rate, which would also hamper businesses in terms of their confidence and investment if this will be not managed well.
Which sectors are most impacted here? And are there going to be some sectors that will be perhaps resilient in this situation?
Well, clearly, it's going to be the manufacturing sector. We saw, of course, the first 2 months of the year, strong
Correct.
performance
Yeah.
when we look at manufacturing PMI.
Tech.
But starting this month of March and in upcoming months, we could see that PMI number to pull back because the orders of manufactured goods and the production will pull back as well because in light of this crisis. So the manufacturing sector, which is also very much a tradable sector, will be hit by the supply chain disruption and the high shipping cost associated with this crisis.
Okay, so apart from the usual transport, even food, no, because of the fuel cost to just transport the food and all of these things, electricity prices will be shooting up as well. I want to get some of your insights on the rest of the issues apart from the oil. What should we be watching out for from an economic standpoint? How are we impacted by this ongoing war? Are we going to be impacted in terms of external trade? As you mentioned, you already mentioned the manufacturing sector, the fact that we have 2.5 million OFWs working there, remittance is going to be hit. What other things need to be considered here apart from the oil story?
Well, the oil shock that we are experiencing has, multiple effects, and that spans across various sectors. So manufacturing is one, but as we mentioned, food is another. So the agricultural sector will also be negatively affected. There's also the services side. So indeed, you have transport and storage, logistics. But also to point out that once you have remittance slowing down from the Middle East, that could also hurt the domestic consumer spend and even the property sector, which depends also on the OFW remittances, may also feel the pinch when it comes to this, slowdown on remittances. So overall, you could see more risks occurring on the balance of payments of the Philippine economy because you have not just trade deficit widening on both goods. On the good side, the surplus on the trade services could also shrink because you have export of travel services being hampered. Likewise, foreign investments might be curtailed because you have a low investor confidence. In fact, we now see stock markets around the world going down. So that showcases that the investor sentiment has been hurt as well by this crisis. So lack of foreign investments will also translate into a widening of the balance of payments deficit. And that would push also more pressure on the local currency to depreciate. So our year-end target of 58.6 for the dollar peso is still intact, but we also see now more upside risk to our dollar peso target as we have a more prolonged crisis in the Middle East, and if this is not contained anytime soon.
Are you in a position to give us a growth estimate?
Well, we currently have a 5% GDP growth estimate for the Philippines, and that I think is
5%?
within
Five.
5% for this
Okay.
year. But a sub 5% in the first two quarters of the year. And that is also because of the low business confidence that's coming from the crisis. So a slower pace of growth recovery is still our baseline view, and we're banking on the second half of the year to have a accelerated recovery, and that assumes that this crisis that we are seeing from the Middle East is put to a stop before the second quarter ends. If not,
Okay.
then we'll likely revise lower our forecast because the several months of oil shock would be, I think, would have a more consequential effects on our domestic economy.
Okay, but still higher than last year's print. So that's still
Yes.
a quite positive development there, considering you've already taken into account the risks of this war, the downside risks on that. Thank you so much for your insights, Angelo Taningco, Research Head and Chief Economist over at Security Bank.